What's up everyone, it's Bevo Music and welcome back to the channel. Today, we're diving into the world of bonds, one of the most popular investment vehicles out there. You hear about them all the time, but do you really bonds? A lot of people think they're boring, but trust me, they can be a powerful tool in your financial journey. We'll explore both the advantages and disadvantages of investing in bonds, so you can make informed decisions about whether they have a place in portfolio, because remember, personal finance is all about what works best. There's no one-size-fits-all approach, and bonds might be perfect for your neighbor, but not right for you. By the end of this video, you'll know if bonds deserve a spot in your investment strategy. Okay, so let's talk about the good stuff first, the advantages of investing in bonds. Now, bonds might not be as glamorous as, say, investing in a hot new tech stock, but they offer something really valuable: stability. The biggest draw for most people is the steady income bonds provide. See, when you buy a bond, you're essentially loaning money to a government or corporation. In return, they promise to pay you back with interest, typically twice a year, like clockwork. This is known as a coupon payment. Think of it like getting a paycheck from your bonds. This predictable income stream can be a game changer, especially for those in or nearing retirement, or if you're just someone who likes to know exactly how much money is coming in each month. Another massive plus is that bonds are generally considered lower risk compared to stocks. The stock market can be a roller coaster, with prices swinging wildly up and down. Bonds, on the other hand, tend to be much more stable. They're like that reliable friend who's always there for you, no matter what craziness is happening in the world. And that brings us to diversification. You've probably heard the saying, "Don't put all your eggs in one basket." Well, the same goes for investing. By including bonds in your portfolio alongside stocks, real estate, or other assets, you're spreading out your risk. This means that if one part of your portfolio isn't doing so hot, let's say the stock market takes a dip, your bonds can act as a buffer and potentially soften the blow. They can help you sleep better at night knowing that your entire financial future isn't riding on the performance of just one type of investment. Now let's get real, no investment is perfect, and bonds are no exception. Just like that friend who's always there for you, but sometimes borrows money and forgets to pay you back, bonds have their downsides too. The biggest one that people often point out is that bonds typically offer lower returns compared to stocks. While stocks have the potential for explosive growth, bonds tend to grow at a slower, more conservative pace. So, if you're looking to get rich quick, bonds probably aren't the way to go. Then there's interest rate risk. When interest rates rise, the value of existing bonds tends to fall. Think about it. If you could buy a new bond today with a higher interest rate, why would you want to buy an older bond with a lower rate? You wouldn't. And of course, we can't forget about inflation. When prices of goods and services increase over time, the purchasing power of your money decreases. So, even if your bonds are generating a steady income, that income might not buy as much in the future if inflation is high. Another potential downside to consider is that bonds can be less liquid than stocks. Liquidity refers to how easily you can buy or sell an investment without affecting its price. Stocks are generally very liquid, meaning you can usually buy or sell them quickly and easily. Bonds, on the other hand, can be a bit more complex. While there's always a market for bonds, it might not be as easy to find a buyer immediately, especially if you're trying to sell a large quantity or a less common type of bond. And finally, it's important to remember that not all bonds are created equal. Some bonds are riskier than others, depending on the issuer, the maturity date, and other factors. For example, bonds issued by companies with poor credit ratings are generally considered riskier than bonds issued by the government. It's crucial to do your research and understand the risks involved before investing in any bond. Don't just blindly jump into an investment without understanding the potential downsides. Remember, knowledge is power when it comes to your finances. So there you have it, the good, the bad, and everything in between when it comes to bonds. As you can see, bonds can be a valuable addition to a well-diversified portfolio, especially if you're looking for stability and steady income. However, it's crucial to be aware of their limitations, such as lower potential returns compared to stocks and the impact of interest rates and inflation. Thanks for watching. If you found this video helpful, don't forget to like and subscribe for more financial tips and insights. Remember, the more informed you are, the better equipped you'll be to make smart financial decisions. Leave a comment below with your thoughts on bonds and whether you think they're a good investment. Have you invested in bonds before? What has your experience been like? Let's get a conversation going in the comments.